Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from TicketTacker. We have a fast market to the downside in gold, down about $48. We got a fast market on the downside here. We have activated a buy signal here on silver, and the market has reverted from the buy to level of 26.20. Now, the market is moving fast from that level, so use your judgment in terms of the magnitude away from the B2 to measure the risk. Right now, you're running about a $500, $600 risk, and the market hasn't settled yet. So we know I recommended this morning to cover any short hedges, any short positions in my private trading room, and prepare for a reversion, basically to unfold from here, and I think we're beginning to see in terms of the activity that we have found buyers. The VCPMI identify the 26.20 as the buy to level in the silver market, and the action that we have here by trading above it is activating a buy trigger after testing the level below. And if it closes above here, using the 15-minute bar at 7:15, it's going to activate a buy trigger. The gold market almost came down to the monthly buy one level of 1781. 1784.60 is the low so far. And if you again covered if you bought the dust hedge that we recommended in our private trading room yesterday, we recommended to cover that hedge this morning, take the profits on the dust hedge, which essentially is a bearish ETF that gives us some downside protection, and now we're getting on the long side. And once we get a little more confirmation here, then we can decide if we want to take some more risk and we want to add to our core position at these levels here. From a mathematical point of view, these levels have been expected, again, since the beginning of the month. We put out basically the monthly numbers here. What I want to point out to you here that the 1810 is actually the annual average price The 1810 is the yearly average price. The 1881 is the monthly buy one level. and the low so far is 1884.60. And the question is it going to come down to activate the 1781, or we're going to find buyers higher than that and get back through the yearly average price of 1810, at which point it will negate this bearishness and it will activate once again the bullish uptrend for the year. We got a fast market in gold here to the upside. The signal, the algorithm seems to have picked up buyers at a higher level than the expected monthly target of 1781. The low of 84.60 today is an important low, and we want to see if this holds, because if it holds here, then this is pretty much what I expect that could be the completion of this correction, which is a corrective swing down correction to test the lows under 1800. And obviously it's come down and has tested the daily, which is neutral. When it trades below the B2 level, automatically goes neutral. Then the system integrates into the weekly numbers, and when it closes below the weekly numbers, the system becomes neutral, and then it activates the bigger picture, below. And in this case, you're looking at the monthly level of 1781 to be the next target. If we get back above 1807, 1810, it's going to be a very, very strong signal, because you're looking at a harmonic relationship on the annual signal of 1810, trading above it, also activating the buy signal, the buy 2 weekly of 1807. So it's a pretty strong signal. If we get through 1810, it's going to bring in and pretty much complete the monthly, weekly, and the annual trend momentum will validate those buy trigger points activated. What you're looking at is a reversion to the mean unfolding. And the mean we're looking at is 1810 on the annual. The monthly mean you're looking at, let's take a look at the monthly chart here. $18.74, and what you see here basically is that the price came up to on just the 29th, just a few days ago. Basically, it got up to 1878.90, and that was the monthly target that we've been working with pretty much as the monthly average price. And if you listen to my videos here for the last few days, I've been saying the market is trading in a trading range between the averages of the yearly and the monthly. Now, 1878.90 to basically, hang on, bear with me, please. The range is 1874 to 1810 on the average, and the buy one level below of the monthly is 1781. So we have a pretty clear picture of what we can expect now from the prices, and waiting now for the market to confirm it. And I think this is one of the toughest, I think, parts about trading is when to wait and be patient. And I'll share this with you that basically the VCPMI has given me the ability to be able to manage my emotions a little more, you might say, methodical in a sense, in terms of the application, because once I understand where these numbers are, once the algorithm identifies these numbers and identifies the probability behind them by giving them a color, and since we don't know basically, whether it's going to be a good signal or not until the market does validate or negate the signal by either completing the target or negating the target. And so the market is the one to guide us through this. And the structure basically is a probability structure that identifies when the price, mathematically speaking, is in a level to unfold the momentum, the price momentum. Price is a consequence of the algorithm. Obviously, we don't use price except to enter or exit, but we don't use price to analyze the direction of the market. What we use basically is the momentum of the market. And if we can identify the highest probabilities when that momentum is going to unfold, then we have a working algorithm that can give us a directional signal, and then obviously it's up to our profile as individual traders here in terms of the application, what instruments and how much risk you want to take with it, and pretty much how to manage your money at that point. What I'm doing here is I'm showing you the mathematical accuracy of the application of the VCPMI as a directional signal. It's not 100% right all the time, but it certainly provides for me the mathematical matrix to establish my confidence, basically, in the levels that I'm executing. Testing 1 2. Testing 1 2. I'm getting some. Yes, we are live, and so if you're having any issues, you can just please check your computer. Coming back here to the market, trading last at 1793.94. If you are carrying any short positions, short hedges, or pretty much if you're looking to enter the market here, the signal, the monthly signal of 1781 seems to have completed the target at a higher level. So we want to see the action just validate and confirm. And that, again, going back to the weekly signal here above the monthly is at 1807, and then we have the annual at 1810. And I think this is the level that we want to watch, because closing above 1810 is going to validate the completion of this correction that we saw with higher levels, or buyers interested in buying and paying higher levels. And obviously, closing above it here, it would be very, very strong signal that points pretty much, again, the 1854 to 1874 targets. The upside of the gold market is not over, or in the silver market is not over. What we have seen here over the last couple of weeks, you might say, is a new energy, you might say, that has entered the market based on the availability of using, you might say, this technology that we have, the social networks that we have, and the ability to, pretty much consolidate a sentiment in the market that I think caught everybody by surprise. For the first time, the little guy was able to take a dent, make a dent, you might say, on the hedge fund positions that, pretty much we're witnessing how it works. When you really think about what's going on in the gold market with this tremendous shortage of supplies that we have, the premiums went through the roof. And from what I understand, you can't get physical supply without paying a big, big premium. And so it doesn't seem to obviously reflect in the physical market yet, because the short sellers, the hedge funds, the commercials that are under the commitment of traders report, that pretty much tells you who's on what side of the market, have essentially used the paper markets to sell up to 10 times more supply on an annual basis. And so it, to me, it just doesn't make sense how you can control the price in what is called a free market enterprise by manipulating the price, creating artificial supply that doesn't exist, knowing that whether it's paper supply or physical supply comes into the market, obviously it's going to reflect the price. You can't really manipulate the cash market as much as the paper markets, the futures markets. But the price discovery in gold is based on and has been based on the futures markets, spot price set by the COMEX, set by the London Exchange. And these are set at a convenient level that will suit these short sellers. So the fact that the Reddit crowd discovered the fact that, GameStop was like 130% short the stock, how do you sell a stock 130, 150% more than the stock itself? And unless you want to manipulate the price. And so what we have here is that we clearly have unveiled the manipulation across the markets by our central banks in terms of keeping the lid on the price of gold. They have eliminated price discovery. And when you really take a look at the price of gold, it is not reflecting yet the fundamentals that keep getting worse. The economy is in need of large stimulus packages. And the longer the Feds wait, once again, sounds like an old tune already. Every time I hear myself say this, the deeper the economic damage is going to be. And with the amount of stimulus that they're talking about coming into the market, it is very, very difficult not to see how it can potentially affect the U.S. dollar. It will weaken the intrinsic value. It will implode its purchasing power. And it will translate into price inflation, which is pretty much what we saw in the 70s. Not only did we see in the 70s price inflation, we saw hyperinflation to the point where interest rates had to be raised to 14, 15%, as we had in 1981. These are changing times. I think these are changing of the guards, you might say, in the monetary system. And I continue to look at the precious metals here as a traditional way, pretty much, of giving you a safe haven place where you can put your fiat currency and maintain its purchasing power, at least by converting it into gold. When you're buying gold assets, you're selling dollars on the other side of the trade. So even though the metals markets do fluctuate tremendously, obviously, I feel comfortable at least putting 1/3 of my net worth into the metals markets to give me the protection that I believe we're going to need in relation to the loss of the purchasing power of the US dollar. The value of gold right now is not the real nominal value. It is not the intrinsic value. It is not the economic value in relation to all these other markets that we're dealing with. We seem to have slowed down here. 1784, 1878. Wow, it's almost $100 here in just a few days. This is what I'm talking about in terms of the volatility. The benchmark of volatility has been broken. And, you know, this was pretty much, this came in on the face of all this squeeze rumors that were created by this Reddit social network website here that pushed obviously the price from $24.89 all the way up to $30. But it did not follow through as I personally anticipated it with this kind of demand, supposedly, which exceeded, I believe, over 100,000 ounces of silver. And that shut off the physical market pretty much. That shut off completely the cash market. And yet the prices came down to 26, are down to 26.20, you know, 20 in this vicinity. I just sometimes you look at this thing and you try to make sense of these fundamentals, and you know it doesn't make sense. And you know, I sympathize with the Reddit traders. Basically, if they did buy this market, you know, I'm sure that they got hurt pretty badly here on this move. And you know, this is typical of the silver market in that it is a contrarian indicator because, again, the central banks are the ones that hold the physical. JP Morgan has a record amount of silver, so they can come into the market anytime that is convenient for them to cash in and break the market down, as they did. A $4 move, in the last 4 days. But I'll tell you, I'm glad that the market came down here because it not only it's testing this extreme levels below the mean, but it filled the gap. It filled the gap that all markets do fill one way, you know, in one way or another at some point before the big move unfolds. And so my expectation coming back here to the market and what I'm looking for is I am looking to add into this correction all the way down to 25, 26 even. This blue level identified by the VCPMI is identifying the highest probability levels mathematically where we could identify buyers to come into the market, as we did back here. This was a perfect trap. This was a bull trap, as it turned out to be. So depending upon what you bought, if you bought on margin, obviously you got wiped out, or you had to cough up the balance of margin requirements, margin calls. Or if you bought stock or ETFs, you're down a little bit, but the market is into an area once again where it's identifying where buyers could come in. So we're going to wait now. We understand the AI behind this, where we are, and we're going to let the market tell us from here and confirm from here where it wants to go. 2620 is a buy trigger in silver. As you can see here, it ran out, and I said, don't buy into this. And, we're getting just tremendous volatility here. These kinds of moves. I mean, 30, 40 moves in silver in a matter of, minutes. So coming back down to this level again has activated a buy trigger. And if you enter in the long side on the signal here, just use the 2620 if it closes below on the 15-minute bar to get out. We provide 3 levels of stops. The most conservative one is a close below. If the market closes above 2620, and automatically on the next 15-minute bar, if it closes below 20, you can use that as a conservative stop. And we give you 3 choices of stops when the signal is activated. The first one is the conservative stop. The second one is a dollar stop, a maximum dollar stop that you can use according to your profile. And the third one, particularly when you're looking at the relative implied volatility to the mean from B2 is 95%. The average price is 50-50 standard deviation. The B2 level is 50-95 standard deviation relative to the implied volatility to the mean. So when the signal is activated, that means that if it closes above it, the probability targets automatically the level above as your initial target, which is that 2658. So if you get a signal on the daily even, from 2620 to 2658, that's a 38-cent move. That's a pretty decent move. It looks like we're getting a buy trigger in silver. So depending upon your profile, depending upon, how you manage risk, then you can apply this signal exponentially. The directional signal is in the silver market. The application can be exponential. You can take a look at ETFs. You can take a look at instruments related to silver, ETF stock. You can create a whole slew of strategies from the signal once it's activated, as it is. As you can see, the energy and the momentum is unfolding. What I expect, due to the sentiment or the contrarian sentiment in the price, you might say reflected to the physical market, to the cash market, that buyers or people that are interested, that cannot buy the cash market or cannot buy the physical market at a reasonable price, at a good price, are going to jump right into the futures market. It is the only place left, if you wanted to buy gold, more or less, is to use the futures markets to take delivery. So I continue to see these moves as truly incredible opportunities. The fact that the silver market has not reacted the way that everybody was expecting doesn't mean that it's not going to. This is the thing I've learned about these markets, that there is a saying: buy the rumor and sell the fact. Because when it becomes a fact, usually people sell into it, and what they buy is the rumor in anticipation of any announcement. Testing, testing. I apologize for that inconvenience here. Live streaming is unpredictable sometimes. We're back on silver here on the board, 2350 last. It's activated a buy trigger in silver. So let's follow the signal here as it unfolds. So depending upon your profile, if you enter into the signal, then you can use the level below, 2620 right away, as your initial protective level. It went long at 2623.50. 2620 would be your stop. So that's a 3.5 cent risk that you're running. $150, $175 risk that you're running. But it would have to be on the close below, or you know, underneath here, we're carrying the dollar stop that I recommend. There's no comparison to compare the gold market with crypto. The crypto market is not a currency. It's a virtual asset. It's a virtual currency. It is not a real currency. And so when you put into the context of gold, which has been around for thousands of years, you can't compete. It's a different asset. It's a different instrument. It's got nothing to do with the monetary system, although the reason why people are buying into the crypto is because they are looking for other instruments, alternatives. And the reason why they're not going into gold is obviously because the government has scared people to purchase gold and silver as protection against the weak monetary system that we're in. The third stop is to get out on the close. So here we are with the market testing this buy to level on the daily. We have a live signal. And pretty much this is what I'm showing you, how to manage the signal activated from that B2 level if you have taken the signal. I personally carry about $1,000 stop, particularly in the silver market, because it is a very volatile market. And so underneath the trade, I carry always that dollar stop, regardless of the market or anybody opinion about the market. And you know, if I get stopped out, it's a dollar stop. I'm out, regardless of the signal. It's not a perfect science. Nothing is a perfect science except death and taxes, really, when you think about it. What we're using is a probability model that identifies the extreme levels of the supply and demand in the market. Now, I may very well get stopped out in here, but I'm prepared to re-enter the trade upon confirmation. At least I know my maximum, you know, in terms of a dollar risk. And when you're trading in the silver market, basically you want to give yourself a little more room than, you know, than the conventional stop. You know, if you are trading in the silver market, obviously you understand that it is a highly volatile, one of the most aggressive and volatile instruments to trade. So you want to measure your risk accordingly. You are in a pocket of support in gold and silver. This is the area where the algorithm identifies the area of support to be in blue. And I use the different levels between the monthly and the weekly, to see where the daily numbers are in relation to those pivot points. By pushing the price of the paper market, by manipulating the price of the paper market, commercials are able to obviously reflect that in the price of the futures markets, and that reflection brings lower prices to where we are right now, to the levels where the central banks come in, they cover their short positions, and they accumulate physical gold. They go into the market and buy physical gold. The only problem that we have right now is that you cannot buy physical gold without paying a big premium. And what happened back in 2004 when they clobbered the gold market down to 1450 from about 1700? They couldn't buy the cash market to cover their short positions. There was no physical available. And so the price of the physical market in the spot month went up $80 over the futures markets. They were caught without the ability to buy the futures, to buy the cash or the physical market. So they had to come into the futures markets to cover their positions. And when they do that, this is when you get these short covering rallies that are spectacular. So the opportunity for the central banks to continue to manipulate the paper market by selling unlimited amounts of supply that reflects in weaker prices in the paper markets allows them to control the price in the physical market to a convenient level where they come in and accumulate physical. Again, the problem is that that window is closed. And so central banks, according to the Commitment of Traders report, have increased the short positions. And they're running, $35-38 billion of short positions in the silver market. And so, yes, they have to protect that with all their might, because if we do get another run in the physical market where you can't get physical and you get this worldwide demand to look into buying in the gold market, and they're not going to find the ability to buy it through the physical market, the only place left is ETFs, futures markets, options, the paper markets. And that could be devastating for the commercial banks. And I think we're coming to that point where the price has been so manipulated to the not only the fundamentals, but to the economics of it. So I think if you're getting into the market here, you want to be patient with these positions. Buying at these levels are truly, I think, very economic levels. I would say they're undervalued. They're at the extreme below the mean, even on the daily signal here. So I continue to support accumulating gold and silver down here. On any chance that you get
order partially filled. Order filled.
Sometimes, as frustrating as it may be, that sometimes turns out to be the best time. So I am patiently waiting for more confirmation. And prepared to add to the long side. If we are going to see a reversion unfold, I think you're looking at the current levels to offer that opportunity. And as the day progresses, we should be able to see the market confirm these numbers that we're looking at. Once again, ladies and gentlemen, thank you for this great opportunity to share this with you. And I truly, sincerely hope that you are observing this, and every time that you come here, you're becoming a better trader. Thank you. Have a great day. Be safe. I'll talk to you soon. Take care.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks. We're at Master Control here at Ticker Talker. And Steven, this is an amazing platform you've built where